First off, I think everybody when investing should have a three-part process, especially if you're investing. If you're a regular investor, but you're trying to take it to the next level, your three stages should really be a determinant of risk. So the type of environment you're in. So you could consider that a macro factor. Next up, you'd want to construct a portfolio, and you know you're gonna have to depend that on what you want. But a standard portfolio construction consists of, if you're picking companies, no more than you know 1 to 2% in a individual company at a time. Um, that's pretty standard amongst all financial advisors. And I'm not your advisor, so get an advisor or learn how to do that on your own. But you need to structure your portfolio in a way where not everything's based off one company's success. Portfolio, your whole goal is to find the highest return for the least correlation, right? Find that high return, but you have to have that balance. That's why people always make fun of hedge funds in crazy years where bull markets rage, because they're like, whoa, they underperform the S&P, but then in years where the S&P's down 30%, they're down 2%. So that's a big thing. And then the final thing is the actual picking of your assets, and that's it's probably one of the most complicated ones. That's determining a fair value. That's determining what companies will be successful in the future. That's the one that's the hardest to master. So we're gonna go over the first step today, which is determining risk. And that's there's many ways to do this, but we're gonna talk about the lumber to gold ratio because it's probably the simplest. And I know there's literal funds based off this ratio, this risk on, risk off. Buster, I was just reading, he said, gold is stay, lumber is growth. Yeah, impartial, that's true. Um, More so though, lumber's an indicator of credit creation. It's an indicator of housing because, every house in North America is built from lumber. You could argue concrete and whatnot, but every house is built from lumber. You need wood. So when you're pricing in the price of lumber, which historically has had very low volumes, so it doesn't dramatically change like crazy, it's a very good indication of investor confidence in credit. So that's in interest rates and in the ability to lend. And then it also has a huge impact on housing. So that's new housing starts, because if lumber's highly expensive, nobody's building new houses because they can't afford to do it. And if they are doing it, the price of housing is going wild. So, you know, we saw at the beginning of this year lumber go wild, right? You don't want to see that, because you know what this means? This means that housing goes wild. This means that credit goes wild. This means that nobody starts to build. This is a slowing economy. It's funny that the price of lumber can do this. It's funny what the price of energy can do. As an investor, if you're brand new to it, you should definitely learn about debt. You should definitely learn about commodities, and you should learn about how that affects companies, how that affects the market, whatnot. The lumber ratio, yes, is a growth ratio. It's a measure of, you know, a rapidly growing economy. So you don't want to see spikes like what you see on screen. You want to see gradual growth in that, and that'll probably fuel new housing and lower credit rates. Cheaper. It'll be cheaper to borrow. Economies will thrive, and as a result, companies will thrive, investors will thrive, and whatnot. Industrial production will be through the roof. So the price of lumber, the futures for lumber, is a great indicator for that side of the ratio. And you got to understand, ratio is just math, right? It's just one over the other. So in this case, it's the price of lumber over the price of gold in the same time frame. Um, and so we got one half of the ratio. So as that one rises or lowers, it affects the ratio, but it's also in relation to the second half of the ratio. So for gold, I think most people can realize it's a store of value. Gold's been a store of value for 6,000 years. It's something that doesn't tarnish. It's something that will always be there. It's the same no matter what happens to it. So, and not only that, it's used in electronics now. So the gold market got even more complicated. The one thing gold lacks is the ability to pay with gold, right? Look, that's why all the countries turned off the gold standard because transporting gold between countries was a nightmare. So then they ended up just storing it all in one country. Um, so that's where gold lacks in one sense, where you're never going to pay with gold. This is where people have the argument against, oh, Bitcoin over gold. They're not the same thing at all, right? Bitcoin's you could believe whatever you want, but in Bitcoin's current state, it's just an asset. It's not a payment processing. It doesn't provide currency. Nothing. Um, it's not a very good store of value, right? It's very tied to investor emotion. So you could even argue a lumber to Bitcoin ratio might be better than a lumber to gold. But the problem is there's too much retail investing in Bitcoin, in my opinion. So, but your whole goal with the gold side of the ratio, the bottom half of the ratio, is to determine investor confidence and investors' real income and investors' ability to not only buy like live, but their ability to buy assets and their ability to feel confident in buying those assets, right? If people are feeling so unconfident, they're going to turn to silver and they're going to turn to gold because they might not make any money. They're not going to lose any money. Their prices stay relatively flat, right? The gold half of the ratio is crucial to this ratio because it provides the investor side of things, right? We have the credit side of things. We have the ability for companies and economies to grow, but we also need the side for investors to invest because ultimately, if we're trying to determine the environment we're in, we need to take into investors' confidence in that market. So basically, you can think of the top half of the ratio as a measure of the economy and a measure of the markets, and the bottom half is a measure of investors. And that's the most crucial part to understand. So you can use the lumber to gold ratio to determine a risk on and risk off environment, but understanding what's driving it is far more important, right? Are we seeing a collapse in credit? Are we seeing a absolute growth in credit? Or are we seeing, you know, heaven forbid we saw a collapse in gold, like that would cause some major problems um, on its own. But the ratio might look good. So that's where you see some issues. That's where you see some issues. It's like understand the ratio, not looking at the ratio, right? Understand what drives it. So that's why I spent this whole, first 15 minutes talking about what drives it because that's far more important than the ratio. But actually understanding how to use the ratio is also just as important. Yeah, let's just go over this now. So, when lumber outperforms gold, you're going to see a rising ratio, right? And you're going to see that basically means new housing is starting, credit's probably becoming cheaper to borrow, which will drive economic and financial market bull runs, if you want to call that. It can be a good signal in our current case where, the lumber to gold ratio has been inverted since November of last year, right before, basically 2 weeks before we saw a major decline there, right? Lumber led all that out. So lumber outperforms gold, risk on, buy equities. Gold outperforms lumber, meaning that a ratio is declining. Switch to treasuries. Yeah, that's how the ratio works in theory. Um, in terms of the 13-week period, let's just focus this camera. I don't know why yeah. In terms of the 13-week period, that's obviously, 2 months and 1 week. A lot of credit creation comes into that, and a lot of what's the right word here? You know, investor sentiment on the actual market consists of, 2 months to a quarter, right? That's why companies put out quarterly statements. That's why, any solid investor is not making a decision based off of less than a quarter, right? It's otherwise you're just basing everything off investor emotion because you get hard cold facts every quarter, but you get emotions every single day. And that's why you see these dramatic spikes and dramatic price action over the course of weeks and, days and even months. But over a quarter, things tend to be where they should be, right? Over a year, even more so. But if you're making these decisions, you're going to be too late to a lot of things on a year. Whereas 13 weeks, pretty close to a quarter. Things tend to change around that 13-week mark between, you know, the economics, the financial markets, the pricing of certain things, financial statement starts getting released. If you guys ever want to email me, it's just Brayden Boyko at boykowealth.com. If you go to the website, it's really easy to get in contact with me. So, yeah. Anyways, I'll see you guys next week in one of these. I'll probably have a guest on next week. Make it a little more back and forth with someone. So, yeah. Appreciate it, guys. See you later.